Okay, great. Let's talk about insurance companies. Now, insurance companies help individuals and companies offset the risk they face. And in general, individuals and companies buy insurance contracts to protect themselves, against a potential loss. And, it doesn't matter if it's individuals or companies, they typically pay insurance companies upfront, and there are like non-refundable premiums also when you want to purchase an insurance contract. But why insurers are also part of the financial intermediaries? Well, because they connect buyers of their insurance contracts with providers of capital that are willing to take the risk. The risk being the insured risks. And this way everybody benefits. The buyers of insurance contracts benefits because they can transfer the risk without searching for somebody who would be willing to assume those risks. And the providers of capital benefit because the insurance companies allow them to earn a return for taking on these risks without having to manage the insurance contracts. So I think so far we have seen that how economies benefit from the existence of the investment industry, and also understand the investment industry. It comprises of all the participants that are instrumental in helping savers invest their money and helping also spenders raise capital in the financial markets. Now, it is also important to know that the investment industry and its participants do not exist in isolation. They operate within economic systems. And economic systems can take many forms, from pure capitalism with free markets to planned economies with centralized authorities. Now, capitalism is an economic system that promotes private ownership, meaning an economic system in which a country's trade and industry are controlled by private owners, for profit, rather than, by the state. But, we say, capitalism, free markets, and all those kind of things. But, in reality, free markets and capitalism exist only in theory. In the real world, governments play a role in all economic systems. But obviously, we can find the closest form to capitalism, in Western economies, because the government's role in business may be relatively minimal there. But economies with centralized authorities, or planned economies, on the other hand, are largely dependent on the extraction of natural resources. And Middle Eastern countries and former Soviet republics could be a good example of planned economies, since the government has control over most of the key national industries. Now, the whole concept of economics, which we will see more of in the economics section of the course, revolves around scarcity, the fact that desire for goods and services is unlimited, but resources are limited. Resources like labor, real assets, and financial capital. Now, because resources are scarce, we all have to make decisions regarding how to allocate these resources. Now, when I say we have to make decisions, there is a very, very important concept called opportunity cost, which we will discuss it later in the economics section. And we will also mention it in the quantitative concept section as well. But for now, to illustrate this concept of scarcity, assume that you as an individual have a limited budget. In other words, your financial capital is scarce. So, should you spend your money buying food or, I don't know, purchasing a new car or paying your mortgage? And similarly, should a company focus its resources on the existing products or on a new one that might produce, a higher profit? And we can say the same thing about governments. Should governments spend money on healthcare, education, or infrastructure? Okay, now in a well-functioning investment industry, everybody can benefit. And in order to have a well-functioning investment industry, trust is essential to the proper functioning of the financial system in general and the investment industry in particular. Because, for example, you as a saver should be confident that you'll be treated fairly. That's why there are laws and regulations to, ensure that investors are treated fairly and honestly. For example, the US Securities and Exchange Commission, SEC, you remember what securities mean, right? Anyway, SEC is a large independent agency of the United States federal government that was created following the stock market crash in the 1920s. And the reason it was created was to protect investors and the national banking system. So they were created, to protect investors and maintain fair and effective markets. Now let me give you an example regarding, laws and regulations. For example, trading based on non-public information that could affect the security's price, known as insider trading, is forbidden in most jurisdictions. I'm going to continue this section by talking about brokers and dealers and their role, and end this section with the main investment industry participants. Okay, now when investors want to buy or sell shares, they need to find another investor who is willing to sell or buy shares. Now, brokers and dealers are trading service providers that facilitate this trading. Now, in terms of brokers act as agents, meaning they do not trade directly with investors, but help buyers and sellers find and trade with each other. In contrast, dealers act as principals, meaning they use their own accounts and their own capital to trade with buyers and sellers. They make markets in securities by acting as buyers when investors want to sell and as sellers when investors want to buy. And the way they do it is that they often have thousands of clients. So if one client wants to sell shares at a certain price, the dealer can usually, identify another client who is willing to buy the shares at a similar price. Now remember, brokers and dealers both provide liquidity and help, reduce transaction costs. And as I mentioned earlier, liquidity and, low transaction costs are very beneficial to investors. And in terms of transaction costs, if you take transaction costs today, and compare it with, let's say 30 years ago, it's not even comparable. It is much, much lower today. Okay, great. Now to finish this section, let's talk about who are the major investors. And there are many different investors that are active in the marketplace. Now, investment banks are part of the major investors. Investment banks are organizations that assist companies in going public and raising money. And this whole process, involves holding at least a portion of the securities over the long term. That's how they are active in the marketplace. Now, mutual funds are regulated investment products that are built from pooled funds, meaning, they use investment capital from multiple investors to invest in different things, and their goal is to achieve return through diversification. We will talk about diversification later. And there are over 1,000 of them available, and because they are regulated, they can be offered to the public. And some of them are passive and some are active managed investments. Passive, meaning they track an index of some sort, and active means that there is a manager involved. And nowadays, many individuals keep their money in mutual funds. Then mutual funds, make long-term investments in companies that, meet their specific criteria. And you should also know that, mutual funds are required by law to act as investors, not as traders. And there is a big difference. Now, hedge funds, like mutual funds, are regulated investment products, but, with less regulatory oversight. And, hedge funds are only offered, privately as opposed to mutual funds as are offered publicly. Meaning, in order to invest with hedge funds, you have to be an accredited investor to qualify. And the other big difference that mutual funds have with hedge funds is that they are, known for taking higher risk, but obviously with the goal of, higher returns for their investors. Okay, now institutional investors, these are large organizations or persons, that hold large stakes in companies. Institutional investors often, include company insiders and special opportunity investors. And last but not least, retail investors. Retail investors are individuals that invest in the stock market for their personal accounts, like you and I. And at first the influence of retail traders may seem small, but as time passes, more people are taking control of their portfolios, and as a result, the influence of this group is increasing, and especially after the whole corona situation that happened, or crisis, I should say. More people became interested in the whole investing and trading. Okay, so there you go. Now you know a bit more about the financial system and you learn some terminologies. We will talk about quantitative concepts next. See you soon.